Hey everybody, welcome to our webinar for today. We are literally going to give anyone that's late 1 minute because it's infuriating when we have to wait when it starts at 12. So we will give it 1 minute and let people come through, and then we will get cracking to discuss the 3 moves to stay afloat in a volatile market. We're looking forward to it. Says, how are you feeling today?
I'm feeling pretty good, thank you. The sun is shining. It feels like summer is on its way. What's not to love?
Very true. I feel definitely summery today. Definitely summery. So, where are we at? Should we actually give people a minute, Says, or should we just get cracking? How nice are we feeling?
I'd go for a minute. You wouldn't.
Ah, no, I wouldn't.
Meet in the middle.
Okay. Oh, look, there's a minute, 12:01. Right, are we ready? Good. All right, well, look, hello, good afternoon. Thank you so much for joining us today. Like, we know your time is precious, and we're genuinely really glad to have you here. For those of you that don't know, I'm Simon Ruffsedge. I am joined by my colleague, co-founder and wife, Sarah, and together we are chartered financial planners at Claris Wealth. Sarah runs our sister offering called Eva Wealth. And look, let's be honest, look, markets have quite frankly been through quite a lot recently. We've probably had a few sleepless nights about what's been going on recently. So we wanted to put this session together because we thought actually it'd probably be the most useful thing to do rather than sending out an email. We wanted to sit down and walk you through some really practical points and things to hold on to. So for the next 30 minutes, we're going to take you through a couple of points with hopefully no jargon. We're guaranteed to make that mistake. Oh, we'll throw something stupid in there like jargon. We're going to not have a doom and gloom. We're just going to have some clear thinking about how we navigate this next phase. So look, I'm the director. I'm a fellow and chartered financial planner at Claris Wealth. I've spent my career as a financial planner helping families, let me move those along, make sense of their financial lives, particularly at the moments when things feel uncertain.
I'm Sarah Ruffsedge. I'm also a chartered financial planner, as Simon said. I'm the author of a book called Smart Money, Strong Women, which, again, as Simon's alluded to, has grown out of my passion for making financial planning genuinely accessible to women, hence our sister firm, Eva Wealth Management for Women. And over the years, Simon and I have both sat with hundreds of clients through volatile markets, such as this current time. We've seen the financial crisis, the pandemic, and everything in between. And the things that we've learned along the way are some of the things that we want to share with you today. The main thing being that the right mindset makes more difference than almost any investment decision. So that's what today is all about.
So look, volatility, if I can get my words out, is uncomfortable. Of course it feels uncomfortable. You wouldn't be human if it didn't feel uncomfortable. And when you open up the statement and the numbers aren't moving in the direction that you want, that's an uncomfortable feeling too. And look, we're not here to dismiss that. It is remarkably human to have that feeling. But, and this is important, uncomfortable is not the same as unusual. There's a piece of research that Schroders put together, and specifically the head of strategic research, called a chap called Duncan Lamont. And he put it well, look, the stock market falls 10% or more in the majority of years, and a fall of 20% happens roughly every 4 years on average. So this isn't exceptional. It's just the rhythm of markets. The question is not whether volatility will come. It is going to come. It always does. The question is how are we positioned when it arrives? Which brings us on to what we think is the most important idea for this webinar. Let me scoot along. And again, it's the important idea of what is the biggest threat in a period of market turbulence. And it's not the market itself. The market goes up, the market goes down. It has done reliably for over a century. In the long run, though, it eventually moves forward. The real threat is something much closer to home.
The real threat actually is each of us, or more specifically, it's the decisions that we make or that we feel the pressure to make when markets get uncomfortable. And over the years, there's three patterns that Simon and I have talked about as repeatedly witnessing during periods like this. And the first is emotional decision making. Because let's face it, when portfolios fall, the instinct is to act, isn't it? It's to do something because it can feel really overwhelming. But what research shows us consistently is that emotional decisions made in the heat of a market downturn are actually among the most damaging things that an investor can do to their long-term returns. And we're going to show you some numbers on that shortly. So that's the first pattern that we've witnessed. The second is the media. And we all know that financial news is designed to get our attention. And the way that it gets our attention is making everything feel really urgent and really alarming. But actually, this short-term noise is not the same as the long-term signal. And it's really important to learn to separate the two, and one that we can help you develop and that we'll again touch on during today's webinar. And the third one is often one that's quite surprising. It's that even experienced investors begin to question themselves during uncertain periods of time. It's not unusual for the doubt to creep in, and questions such as, well, should I be doing something different? And is this the right time to change the plan? But in most cases, the answer is no. And again, we're going to cover that today during this session. So if any of these three questions or scenarios feel familiar for you, you're in really good company. It's really important to say, they are not signs of being a bad investor at all. They are simply signs of being human. And our brains are wired to treat uncertainty as danger. And there's this sort of instinct that's built into us to want to act to resolve it. Now, looking back in sort of history upon history, that instinct served our ancestors well on the savannah. But we're not in it feels like we're in a fight or flight moment, but we're not. And so this instinct serves investors rather less well today. But the good news is that understanding these patterns is actually just half the battle. And once you can name what's happening, you can then start to make a different choice.
Thanks, Sez. And many of you have seen this chart before or something similar to this, because I think this is just really powerful, and it's one of my favorites, and I want to give you a moment actually to look at it. So sorry, Sez, I moved the slides forward before the end of your thing. But what this shows you is like a 60-year stock market cycle, and the blue sections are bull markets. It's when prices rise and optimism is high, and the orange sections are bear markets, when prices fall and there's pessimism that dominates for a sustained period of time. But what leaps out is how this alternating pattern repeats over and over again across all the decades that it's showing, the 6 decades. The bear markets feel enormous when you're in them, but look at the scale of what follows. The bull markets returns of 228%, 582%, and 400% across the same 60-year span. The average bear market lasts around about 11 months and have fallen around 34%. That is horrible. It just doesn't feel nice. But the average bull market has lasted for 4 years and has risen over 150%. This isn't an argument that things turn out fine quickly. Sometimes recoveries do take longer than we all think, but it's a really powerful argument for not letting a bear market permanently interrupt what is, over the long run, a remarkably resilient story. Let me jump on. Oh, I'm not even ready. Are we ready? Right. So the first of our 3 moves, we're going to move into the 3 moves that matter most. All right. We're trying to keep this on target, and I'm useless with controlling the mouse, apparently. Look, the first is just to stay invested. Let's see if we can get it. Oh, all right. The first is to stay invested. This sounds simple, but look, it isn't always. We hear news, we get information, we chat to our friends, but the data is in its favor, and frankly, it's just overwhelming. So what we want to do is we're going to share 3 pieces of research that we think every investor should know. And the first is, what's the cost of missing the best days of the markets? And Schroders did some analysis on this, and they looked at what happened to £1,000 that was invested in the FTSE 250, that's the top 250 companies in the UK, between the years of 1986 and 2021, 35 years of investing. I'm not going to bore you with all the background for why they picked those years, but there'll be data around that. But the point is, look, if you'd stayed invested throughout that period, that £1,000 could have grown to just under 44 grand. Now, if during those same 35 years you tried to time the market and you had missed just the 30 best days, that same £1,000 might only be worth 11 grand today. That gap is phenomenal, and that is a big gap just on £1,000 worth of investing from just missing those 30 days out of the 12,000 days that there were available. And this is what Nick Kirage said. He's a fund manager at Schroders. He says the irony is that historically many of the stock market's best periods have tended to follow some of the worst days. And that irony is at the heart of why staying invested matters so much. The moment you step out to protect yourself is often the moment that the recovery starts to begin.
So what does half a century of patience look like? There's another study that was taken place by Dimensional Fund Advisors. They're one of the largest evidence-driven investment managers in the world. And their study took a longer view. They looked at what happened to someone who invested $10,000 in the S&P 500 at the start of 1970 and simply stayed put. Over those 50 plus years, they lived through 8 recessions, multiple wars, political crises, the dot-com crash, the financial crisis, a global pandemic. There were quite a few things that went on over that 50-year period. Now, that investor that invested $10,000 back at the start and stayed put, they would have more than $3 million today. That's not because they predicted anything correctly. It's also not because they timed the market, but it's because they simply stayed in their seat. Now, there's another piece of research which we also, I can't get my words out now, which we also think is really helpful to mention. We're going back to Schroders, and they looked at what happened to investors who moved to cash in 1929. Now, this was after a 25% fall of the Great Depression. Naturally, these investors thought they were being prudent, protecting what they had. We all know that feeling, the market's crashing. You know, you want to protect from any further falls. You don't know when the right time is, but you make that move. Now, those investors had to wait until 1963 to get back to break-even point, and that was a period of 34 years. By contrast, the investors who stayed in the stock market through that crash, they actually reached break-even in 1945, which was 18 years earlier than those who came out. Now, hindsight obviously is wonderful, but we can see in that example that the safe choice, as people thought they were making, actually cost nearly 2 decades of financial progress.
And as I'll go back to saying before, like the timing frame of this, there's always anomalies, there's always process in there that doesn't fit the bear market and bull market timeframes that we talked about early, and that is one of them. And what we're not saying is that staying invested is always comfortable. It just sometimes isn't. And we're not dismissing the very real feelings that come from watching your portfolio move in such dramatic forms. But what we are saying is this: the evidence across the decades, across the markets, is remarkably consistent. Time in the market beats timing the markets almost every time.
So, thank you, Simon. The second move we're now going to look at is staying diversified. Now, we want to be precise about what we mean by when we say diversification, because it is a word that gets used a lot, and sometimes I think it can lose a bit of its meaning. So diversification is not necessarily about having lots of different things just for the sake of it. It's about understanding that different asset classes and different geographies, different sectors, they all behave differently during periods of uncertainty. And it's this variety which actually gives a portfolio its resilience. Now, one of the most important things we feel that we do at Claris Wealth, and something that we think is often undervalued in financial planning conversations, is to actually think really carefully about what each part of your money is actually for. Because not all money has the same purpose. And we very much believe that purpose determines how much risk is appropriate to take. So often a financial plan isn't just one pool of money with one risk level sitting on top of the whole thing. It's often a series of different pots, each with its own time frame, each with its own goal, and therefore each with its own appropriate relationship with market risk. So let's take an example. Let's say that you are planning to buy a property in the next couple of years, or you've got school fees to pay, or you're looking to replace the car, something like that. You've got a fixed time frame in the near term where you're going to need this pot of money for. Now, that money, and we talk about this a lot, clearly should not be exposed to market risk because the timescale is just too short. There's not enough runway for a recovery if markets do fall. That money belongs in cash or near cash equivalents, where the value is going to be stable and where it's accessible when you need it. Now, if we contrast that to a pension, for example, let's assume you're 55 today, you're planning for a 30-year retirement. Now, that money, by contrast, has an extraordinarily long horizon. So market volatility today actually is largely irrelevant to what that portfolio will be worth in sort of 2045, 2055. In fact, if that money is sitting in cash because of the current market turbulence, for example, the real risk over that period of time isn't the markets. It's actually inflation quietly eroding the value of what you've worked so hard to accumulate.
And that's something that we think very deliberately about when we're building or reviewing your plans or people's plans. We're essentially asking, what is this money for and when will it be needed? Because the answer to those questions is what should drive the risk that is then taken. It's not the current news cycle, and it's not how we feel about the markets today. So when you hear about market falls and feel the pull to do something, the first question to ask yourself is, which part of my plan are we actually talking about? Is it the pot that's needed in 2 years, which, if we've all done our job properly, shouldn't be in the markets at all? Or is it the longer term investment, where time is your most powerful asset and where stepping out now could actually do you the biggest lasting damage? That's the clarity that a good financial plan gives you. It's not just what you're invested in, but it's why and how long and at what level of risk. And when you can answer those questions, market turbulence starts to feel a great deal less alarming.
So thinking back to diversification then, when equities fall sharply, bonds historically have provided a degree of cushion. When UK markets are under pressure, exposure to global markets can help to offset some of that. So this doesn't mean that diversification completely eliminates volatility, because it really doesn't. You will still see movements in your portfolio. But what it does do is it helps to smooth the journey. It means that you're unlikely to experience the full force of any single market event all in one go. It can, I think, sometimes it can help to think of it in a slightly different way as well. So a well-diversified portfolio is built not necessarily to maximise returns in every single environment, but it's built to survive in every environment so that you can actually benefit from the recoveries as well.
And that's the temptation when one part of the market is to do particularly well, is then to concentrate there and to put more into what is working. And this is one of the most common and most costly errors that we see. Concentration risk returns or increases returns when everything goes right, but it dramatically amplifies it when dramatically amplifies the losses when it doesn't. And even the most sophisticated investors in the world are thinking about this right now. Diversification isn't an old-fashioned caution. It's sophisticated risk management.
That's right. So when we talk about staying diversified, what we are actually meaning is staying true to the allocation that we've built together, because that is designed to be resilient across different conditions and not just optimized in today's market.
All right, move number 3. And it's perhaps the most underrated of all of them, and that is just to be disciplined. A plan matters more than the predictions. We cannot tell you what the market's going to do next month. I can't even tell you what it's going to do later today. And the truth of it is that nobody can. And anyone that tells you otherwise is frankly just not being straight with you or barefaced lying. What we can do, though, is we can build a plan that doesn't depend on predictions, a plan that's designed to work across a range of scenarios, not just one that we hope for. And this is where purpose really matters. When a plan is anchored to what the money is genuinely for, whether that be paying the grandchildren's education, maintaining a lifestyle in retirement, or passing on something to people that you care about, it's much easier to stay disciplined. Because the question shifts. Instead of asking, what is the market doing? You're actually asking, Has anything changed about what I'm trying to achieve? And in almost every case, during a market dip, the answer is no. You're still trying to achieve the same thing that you were 2 minutes ago, 18 months ago. One of the most valuable things that a financial plan does, and one thing that people rarely talk about, is that a financial plan removes the pressure to react. When you've got a clearly articulated long-term goal, an investment strategy that's aligned to it, and a cash reserve that covers your near-term needs, the question, should I be doing something, almost always answers itself. No. There's another research house, it's one of the longest running studies of investor behavior in the world, run by a company called Dalbar, suggests that the average investor underperforms the very funds that they're invested in. And that's not because they've chosen poor funds. That's not because of the excessive charges. It's actually because of their own behavior. They're buying and selling at the wrong point. They're selling early. They're moving in and out exactly all at the wrong moments. And the cost, the gap of that, they've worked out to be about 3% a year. So if you multiply that over a 20 or 30 year horizon, that compounds into an enormous difference. Quite often, that could be the difference between the retirement you had planned for and the one that you end up with.
So long-term outcomes, as we've suggested, come from consistency, not necessarily activity. And investors who do best over time are rarely the ones who make the, in inverted commas, cleverest moves. They're actually the ones who make fewer moves. They're the ones who stay the course and who let their plan do the work. And that's what discipline looks like in practice. That's what we're here to help you maintain, and especially in these moments when everything around you seems to be suggesting that you should be doing something different. So, we've talked about 3 practical moves, but now we want to take a step back and look at the thinking behind them, because these 3 moves only work if the mindset is also right. Now, on this slide, we're going to show you some thoughts, and they're the sorts of things that we hear from investors when markets are falling. And then once we've shown this, we're going to show you a different way to hold the same situation. Now, these thoughts are very human thoughts. They're not wrong, they're just human, but they can lead to very different decisions. We hear different versions of these in almost every conversation that we have with people during periods like the one that we're in now. And they don't come from individuals who aren't thinking clearly. Actually, they come from people who are paying attention, individuals who care about their financial security and who are feeling the weight of uncertainty. The urge to get out, the urge to wait for calm or find calm and to find a way around this discomfort, all of it makes complete sense as a human response. And our instinct when something feels threatening is, as we've said, to act or to move and look to protect what we've got. And that has served us well for most of human history, as we've said, but not for the investor today. So what all of these different thoughts have in common is a hidden assumption that volatility is a problem that needs to be solved. If you could just find the right move, or you could just sidestep the discomfort entirely and still end up where you want to be. But the honest answer is that you can't, not without giving something significant up in return. And that's the trade-off that tends to get missed when markets fall. Avoiding volatility doesn't mean avoiding risk. It often just means trading one type of risk for another. In this case, market risk, for example, for inflation risk, or for the risk of missing the recovery entirely. So the shift that we're asking you to make in your mindset isn't about becoming comfortable with volatility necessarily. It's about asking a different question altogether. It's not, how do I avoid this? It's more, does this change anything about where I'm going? And in most cases, if the plan is sound, if the allocation is right, and if your short-term needs are covered, then the answer is no. Nothing has changed except the number on the screen today.
And what if volatility isn't the problem? But what happens if volatility is the price of something? What happens if volatility is the price of long-term returns? You don't get growth without uncertainty. Trying to avoid the volatility often means sacrificing the very returns that you're trying to get. The goal isn't comfort. The goal is progress. There we go. Towards long-term outcomes. That's not a cold or clinical way of thinking about it. It's quite the opposite, because what it means is that the discomfort you feel when markets fall is not a warning that something's gone wrong. It's the evidence that the money you have is actually working hard for you. Your money is out there in the world doing exactly what you've asked it to do.
Now, if you remember that chart that we showed earlier, where the 60 years of market cycles, where you've got the orange and the blue sections, every single orange section felt at the time absolutely like a reason to get out. The news was alarming, the numbers were frightening. And yet, when we saw on that graph, every case, what followed was a blue section, this big recovery, often like really substantial. And so the mindset shift is this: rather than asking, how do I completely avoid those orange periods, is perhaps to start asking, am I positioned to benefit from the blue upside thereafter? And the answer, if you have a good plan and if you stay invested, is almost always yes.
So, the famous webinar case study moment. We are here, people. You've made it 26 minutes in, and we're at the case study moment. And so we're going to bring it to life with a wonderful case study. And I should tell you, it's a composite. The details have all been changed. It's not been drawn from any single client event, but it's a pattern that we've seen. Okay, here we go.
Perhaps photos of you and I when we're a bit older.
Yeah, I look good in pink, so that's good. This is your bit, by the way.
Thank you. Right, I was just, taking in the photos. So we've got two hypothetical clients here. We have got Margaret and we've got David. Now, two investors, same starting points, and let's look at the outcomes. Both retired in 2019. Both had similar portfolios. Sounds like you and me, Si, doesn't it already? Broadly diversified, with a mix of equities and bonds, positioned for a 20-year retirement horizon. So all from the same starting point. 2020 arrived. We had the pandemic. Markets fell sharply. The FTSE 100 dropped around 35% in a matter of weeks. I'm sure we can all remember it was not fun.
Margaret, sensible, she called us. She's worried. We talked through the plan, what it's designed for, what the cash reserve she has, and why the diversification is doing exactly what it's supposed to do. Did she enjoy the experience of seeing her portfolio do what it does? No, but she listened and she stayed invested and turned off the valuation updates.
And without giving too much away, David didn't call, he didn't look at the numbers, decided that this period was different, and he decided he was going to move to cash in March 2020, which, as it turned out, was right at the bottom of the market. Now, his intention was to get back in when things had calmed down. But when do you know when things have calmed down enough? And so by the time that he felt calm enough, what we then saw was actually markets had already recovered substantially. So he got back in later at higher prices, having then locked in losses and missed out on a substantial part of the recovery.
Both investors experienced the same market, the same headlines, and the same human fears. The difference was the decision they made in those few weeks. Margaret's portfolio by the end of 2020 had recovered and was ahead. David had the gap that we talked about earlier, compounded over many years ahead, and it represents actually a meaningful and permanent reduction to his retirement income. The markets didn't treat either one of them any differently. It was their response that changed everything. And that is exactly why those three moves matter, not as abstract principles, but as decisions that can determine real outcomes.
Thank you very much. My lights have just gone out. I'm so sorry. Bear with me.
Do you want me to pick this bit up?
Thank you. Yeah.
Okay. So look, while Sarah deals with the liveness of live webinars, right? So we want to leave you something concrete. Like there's 7 things here on this checklist that you can come back to when you're feeling unsettled by what's happening in the market. And they're not meant to be rhetorical questions. They're actually actual questions that we should all ask ourselves when reviewing anybody's situation during turbulent times. And the vast majority of these cases, you can work through them, and as long as you're honest, you can probably produce a really reassuring answer. Look, number one, do you have a clear long-term plan? If the answer is yes, is what's happening in the market today changing the plan, or is it just making you feel uncomfortable about it? Because those are two very different things. Number two, am I invested in line with the plan? Is the portfolio that you have still aligned to your goals and your time frame? If it is, the plan is probably working as intended. Number three, is my portfolio diversified appropriately? Not just do I have different things, but is the mix genuinely designed to be resilient across different market conditions? Number four, am I reacting to headlines or sticking to a strategy? Honestly, we all know this bit because the media's job is to generate urgency to sell the news. Your plan's job is to generate long-term outcomes. They are so different in their purpose. Number five, do I understand what my plan is designed to deliver? Not what did the markets do this month, but what is it designed to achieve over the full time horizon that we're planning for? That's the only number that really matters. Number six, and this is the crucial one, has anything in my personal situation actually changed? Markets moving is not a change in your personal situation. A change in income, health, goals, or timeline, that is worth a moment of review. But the markets being volatile, well, we already built that into the plan. So, do you have enough liquidity for your short-term needs? If you do, everything's fine. If you don't, we need to look at it. If your day-to-day expenses are covered without needing to touch investments, you have the single most important buffer against being forced to sell at the wrong moment. Uncertainty doesn't need to change your plan. It's the reason you have one. And so, 2 minutes over, we want to close with this thought on this slide because I think it captures everything that we have been talking about today. Uncertainty is not the enemy of good financial planning. It's the context in which good financial planning proves its worth. The three moves that we've talked about today, staying invested, staying diversified, and staying disciplined, are not about pretending markets don't fall. They're about being positioned so that when they do, your long-term outcomes are protected. The evidence behind these moves isn't just theoretical. It stretches across decades, across markets, across hundreds of thousands of real investors. And what it constantly shows is this: the investors who stay the course, who resist the pull to react, who trust a well-constructed plan, those are almost always better off.
I think, excuse me, it's also worth noting that we do understand that this isn't always easy and markets can be genuinely unsettling. So if you're watching the news and feeling worried, it is a completely normal response. But we would also ask that you do this. Please do speak to us. Not because we've got a crystal ball, as Simon said, we really don't, but because we can help you work through these 7 questions that were on the screen, and we'll be sending out a checklist for you as well, but we'll help you to look at your specific situation and make sure that any decision that you make is based on your life and your goals, not just on what's happening on a trading screen this morning.
Look, thank you guys so much for your time today. We really value the time and the trust that you all place in us, and sessions like this where we get to talk to you guys are something we both feel really fortunate to do. And look, if it's prompted any questions that you want to chat through, we're really happy to reach out. And I have just checked, I don't think there's any questions, so Saz, we can just close it off. Thank you so much, everybody, for joining us. Take care.